Hey traders, this is Jason from Leavitt Brothers. How you doing? It is Sunday, July 28th. Hope you're having a good weekend. Want to do an update of my State of the Market series, video series. Haven't done one in a while. Market's done really well off its June 24th low. So I want to look at the charts, look at the indicators, see maybe what they hint going forward. As this summer, it's not starting to wind down. We've still got another month or so. But still, given the run we've had, I want to see kind of what the indicators say, what may be in store for us next. Okay, so let's get to it. So the first chart here is the S&P 500 60-minute chart over the last 12 months. The thing that jumps out to me is, from the November bottom through April here, we had a pretty steep, narrow channel. And now the channel seems to be getting bigger. It's less steep and it's widened out some. Also, despite how big the run is that we've had since the June 24th low, it's pretty much in line with the last rally we've had. A little bit of space up here. The top trend line is drawn parallel to the bottom, so there's actually a little bit of space before that trend line is hit. But still, this kind of puts in perspective that despite how big the run is, it's actually pretty much in line with what just happened just a couple months ago. So that's the state of things. We've had a really nice rally. Things are like widening out now, and we'll see what happens next. Now let's look at the indicators and see if they hint at anything going forward. Okay, here's the S&P 500 versus the 10-day moving average, the AD line. I show this pretty much every week with my weekly report. I've noted for like a couple weeks that a divergence was forming. The divergence is now complete. The AD line is now headed down to zero. In the past, when we've gotten divergence where the S&P 500 makes a higher high and the AD line makes a lower high, it tends to lead to a pullback. Although it hasn't always been extremely sensitive. Most of the time, it's pretty close. As you can see here in May, we got a divergence, and they pretty much nailed the top pretty closely. But as you can see in March, we started getting a divergence, and it actually took several weeks in order for the market to actually pull back anything noticeably. So something to keep an eye on. It doesn't guarantee anything, but if you're long, if you're looking to enter new stocks, you definitely got to pay attention to the fact that, like, hey, this indicator might be suggesting we have a little bit of weakness in the near term. Now, another thing I look at is how it acts when it gets down to zero. If it can bounce off zero, bounce off the low, 100 here, and like stay above zero, then I think there's a really good chance the trend is just going to continue. If we go below zero and it stays below zero, then odds are we're going to get a bigger correction. Okay, not necessarily a full-blown bear market, but just a minor correction that might last a week. It might end up lasting 2 or 3 or 4 weeks. Okay, so how this acts around zero is pretty important to me. If you're bullish, you want to see it stay above zero. If you're bearish, you want to see it go below zero and stay there. All right, so here's the NYSE new highs up top of the S&P down below. Last week, the last 2 days, the new highs dropped off. To me, this is no big deal. There's usually big swings in this number. What I want to see, if you're bullish, what you want to see is you just want to see steady prints up here between 100 and 300 and 400. You don't need big spikes. You don't need high prints consistently coming across the tape. You just want to see a steady flow of decent prints. What you don't want to see is you don't want to see that go down by go to zero, not zero, go to like 100 and just kind of stick around down there. Okay, that would suggest there's more weakness going on than the bulls would be comfortable with. Okay, so right now, no concerns whatsoever, but if it goes down below 100 and stays down there, then it becomes a concern. All right, so the last chart was the NYSE 52-week highs. This is the NASDAQ 52-week highs. As you can see, highlighted in yellow, spikes in the new highs tend to coincide with local tops. You can see here in the beginning of 2012, we had a spike here, and that was a high. Spike here in the middle of the year, and that was a high. We had a cluster of spikes here in the beginning of this year, and that turned out to be a new high. None of these highs lasted very long. They just pinpointed a high, and we got in some cases just like several weeks of weakness, and then the market got bought up again. Okay, not a big deal. So the reason I bring this up is because we did actually get a spike at the beginning of the month. And now the new highs are trending back down. So keep it in mind. No indicator is perfect. No indicator is going to say like you definitely got to get out of everything and go short. But keep this in mind that this is signaling, the spike and then the drop signals a possible too much fluff out there, and now everything's coming back down. So keep it in mind. Next chart, one of my favorites, SP 500 versus the average 14-day average true range. It is my contention that when the market moves up, volatility is very low. When the market moves down, volatility expands. My measure of volatility is with the average true range. So as you can see, the volatility has been dropping, which is exactly what you want to see if you're bullish. Whether the average true range curls up here and moves up, or whether it continues to move down, will be very telling with regards to the market's next move. Okay, if the ATR continues to move down, bulls should be safe. If the ATR starts to curl up, I'd be a little bit weary. The upside is most likely limited. Okay, here is another ATR chart that I use, although I don't post it very often because it hasn't signals in a long time. It is the weekly chart. It's the 20 ATR in a weekly chart. It backs up a little bit, sees the bigger picture, not as sensitive as the daily version. So you go back to 2010 when the ATR started to move up, we got about a 200-point pullback in the S&P. Go to the middle of 2011 when the ATR moved up a bunch, we got about a 250, 275-point pullback in the S&P. Through the spring months of this year, we got a move up that was probably the biggest move up since the middle of 2011. So this is like a 2-year. This rally here is like a 2-year best, and it's one of the things that led to the pullback a couple months ago. Now, it's over the last month, the ATR started to roll over, so this is good news for the bulls. Okay, so if you're bullish, you want to see the weekly ATR continue to move down. If you're bearish, you want to see this move up. Okay, what this chart does is it will go a long way as far as predicting what the market is likely to do next. Okay, if volatility stays low, this chart's going to move down. The market's going to remain in good shape. If volatility expands and this chart moves up, then the market's next move is likely to be down. Okay, so keep an eye on this one. Here's the S&P 500 versus the 10-day moving average of the put-call ratio. More times than not, local bottoms in the put-call have coincided with local tops in the market. Local tops do not mean extended pullbacks. It just means pauses that could last a week or 2 weeks or maybe 3 weeks or something like that. Okay, it doesn't work all the time, but it works enough that you should pay attention to it. Last Friday, we got a little tick up. No big deal. I don't consider this a curl up yet, but I'm going to keep an eye on it. If early next week we get some higher prints here, and it looks like a local bottom is actually being put in place, then it's possible that the market's upside will be limited. Okay, moving on. This one is a little bit concerning. It's the 60-minute chart, so 32 moving average of the 60-minute chart. Okay, if you look back to early 2013, we got this nice run here, January, February. You notice how the tick acted. It was well above zero and steady prints and no moves below zero. Okay, that's a healthy market. If you go to the April-May rally here, here's the bottom. So here's the bottom here, the beginning of the move. As soon as it gets above zero, it like surges and it maintains a pretty healthy level for several weeks to support the rally, and then eventually it falls back. Okay, so characteristic of a strong market is that you get this particular indicator is going to maintain a relatively high level, and it's going to stay there. It's not going to come back down to zero very often. It's certainly not going to go below zero. So if I look at the current move, starting here at the end of June 24th, which is right here, you can see we got a nice move up, but it didn't go up to 200 like it had done before, and then it goes back below zero, and then we got another move up to not even maybe it went up to 140, but again not a very high print compared to the higher prints back here, and now it's gone below zero again. So if high prints are characteristic of a strong market, it's a little bit concerning that that this particular tick chart has not been able to print higher levels and maintain those levels. One more chart, S&P 500 in black. The green line is the 10-day moving average of the percentage of S&P stocks trading at a 20-day high. So very simple. The market does well, you get more and more stocks trading at a 20-day high. The market does poorly, and you get less and less stocks trading at a 20-day high. At times, this indicator is pretty sensitive, meaning tops coincide pretty closely. You can see a top here in May coincided with the top here. But there are times when there's also a delay where you'll get a top in the indicator, and then the market doesn't top for several weeks after. So I know that's kind of like me saying it could work, it could not work, and therefore I'm going to be right all the time. I still have to bring it to it's still kind of my job to bring it to your attention. Okay, the indicator reached a high level, the highest level it's been at in the last year. Now it's moving down. Whether we get a top right now or whether we get a top in 2 weeks, I don't know. That's impossible to predict. But it is something to keep in mind that this thing is looming, and you don't want to completely ignore it. All right, so that's all I have. Overall, I'd say the market is in good shape. We've been in a nice rally. We're in consolidation mode right now, but there are some cracks out there. Okay, whether it's the percentage of stocks trading at new highs, whether it's the tick that's not really supporting things, whether it's the possibility that the PC is going to curl up soon. The AD line is moving down to 0, so we got to watch that. There are some warnings out there that we want to pay attention to. So hope you got something out of this. Have a good week trading, and I'll see you next time.